It's Friday, May 11th, 2018, and this is Midday Money. On today's show, Peter Andersen. You can see him on CNBC, read him in Forbes, CNN.com. He's here on today's show. And stay tuned 20 minutes from now, an actionable idea, something you're going to want to pay attention to. This is Midday Money. We have Peter Andersen from Andersen Capital Management. Hey, Peter, thanks for coming on board Midday Money.
Nice to see you.
Nice to see you. And actually, I was thinking about it. You and I did a radio show 7 years ago.
7 years ago, yeah.
And 7 years ago, the S&P 500 was at 1,300. You think about that. We're at 2,700
yes.
today. You know, up over 100%. Did you think, if you look back, do you think we'd be here?
Well, I think we always knew that things were depressed back then, and people were still trying to crawl out of 2008. And we always tell clients, you know, you have to have a long-term perspective. And it's interesting you bring that up, because I think a lot of people now, their long-term perspective might be 3 months. And so back then, if you had asked that question, where would we be in 7, 8 years? I'm not sure anybody would have the confidence to actually give you an answer, because they're so short-term things.
Yeah, it was almost like we were listening to it on an 8-track when I was listening back. I mean, technology with our markets and everything really is day to day. I mean, we see you on CNBC all the time. And I think part of the problem with the CNBCs of the world is they need to attribute the day's events to the market move.
They do, yes.
And I think what I've always liked about you is you speak to Main Street, and you speak, I get it, and my clients get it when you describe something. And one of the names that I always remember you talking about, and I'm curious if you still own it personally, is Madison Square Garden. I remember you talking about that.
Yeah.
Is that still a holding in your portfolio?
It is not a holding, but you know, it's interesting that you mentioned that. A lot of the names that we probably did talk back then are still in the portfolio. I'm a long-term holder, and I really do mean long-term. You know, when you mentioned the other media interviews, you're right, they are so short-term focused, and I think that's endemic of the entire society now. I mean, we even have a leader now that is using Twitter, and really probably the most contemporary way you could ever think it in terms of expressing thoughts. And so with that, everybody is so short-term focused that it really is, I would think, refreshing to have conversations about stocks that last longer than maybe 1 or 2 years, because a lot of them, you have a thesis, it has to play out. When clients come to us and say, Peter, you've held that stock for a long time, it looks like it's quite volatile, we always have to remember, you know, keep your eye on what the thesis was, and if you cast that thesis in a long-term perspective, stay anchored to that unless things change. And things do change occasionally. I mean, I've forgotten the details about Madison Square Garden, but that certainly did change. But there are many other companies that we still like now. You know
what I like about the way you approach it too is you and I have talked about active management versus passive.
Yes.
And I don't know what you feel about where the market is now, but I want to say it's fairly valued. And I think if you buy the broader index, I don't think you're going to see the same rate of return that if you hire somebody like yourself that is a stock picker that is active in the market. What do you think about that?
I am so happy you brought that up, because I really do have quite a large axe to grind about active versus passive. Certainly we can first posit that certain strategies might flow in and out of being attractive in terms of active management versus passive, but there is this overwhelming, kind of troublesome trend right now where most investors are being lured into being passive investors. And I really don't think that they're getting the full value of the market when you are talking to an advisor that is just totally passive. I'm not saying that there isn't a place for passives, but there's also a place for actives. And you could actually argue that the more people are becoming passive, the more excited a guy like me gets, because you don't have as many analysts looking for uncovering values. And it's truly an exciting time, as it was even 7 years ago, to look at active possibilities.
Yeah, I think it's dangerous, quite frankly, to be passive in this market. And by the way, folks, what passive means is, you know, letting, you know, the S&P 500, 500 stocks, and that's it. You're not buying and selling. You're not selling Burger King and buying McDonald's. Active managers like Peter are in there deciding whether or not it makes sense to hold that position. What concerns me about passive investing is most of them own the Facebooks and the Amazons and the Googles. There's not a lot of thought to buying those names. They're the momentum names. And what we saw in February of this year, those are the names that are the most hurt. And
That's
the individual
correct,
investors that weren't active paid the price for that.
They did. And one other thing about active investing, I think, is that I've sat across the table from many private investors and clients, and while they're happy with, I would say, most services in general, they seem to lack there's a gap for their intellectual interest. And what I mean by that is if they have all passive allocations, they tend to start asking about the fees and is it justified having a manager oversee passive investors? And we often get the question, well, is there anything else you have that might be a little bit more exotic, that might be a little bit more intellectually interesting, and also not just intellectual, but the potential for beating the index.
Financial.
Exactly.
Financial interest.
And so if you're just totally passive, I think a lot of clients are left shrugging their shoulders saying, well, is that all there is? And so to offer them in varying degrees, not the entire core of the portfolio, but sometimes 15, 20, or maybe even 30% based on the demographic of the client, it excites them and it gets them more engaged. And so the meetings are far more, I would say, almost inspirational between the two, because they have conversations about individual stocks. It's a lost art almost, having a conversation about an individual stock, because people are talking more and more about low-cost ETFs. And as I said, I'm not bashing low-cost ETFs, but there's more to investing than just being passive.
Yeah, no doubt about that. Again, my big concern is this passive is being pitched by some of those people on CNBC that that's their bread and butter.
Yes, it is.
And I think what you'll find, and again, when the bond market sells off, there'll be an equity analyst saying this is why, or if when you need to buy stocks or bonds. And I think attributing those day-to-day movements to again, to the tweets of the world is concerning for the individual investor. And I brought up tweets, and you mentioned the president earlier. What I find remarkable, and this is a lot different than 7 years ago, on Fridays I find that the market sells off, and maybe this is just my own observation, sells off in the afternoon because it's afraid of a tweet to come out on Saturday or Sunday. Do you see that? I mean, is that just my imagination?
That is, I would say, that's one of the many new concerns that are factors that people have now when you have this kind of speed of communication. It has changed so much over the past 20 years, right? And I think we are all struggling with how to factor in all this information in a way that makes sense and value added for your client. And that is an excellent example of, 15, 20 years ago, we would have never concerned ourselves about that, but now we do. And it's one of many things that fake news, for instance, we don't know how to really handle all those matters. And we will somehow get calibrated to all this, but from an intellectual perspective, I think it is a truly exciting time period because you can ask, why is there so much unrest in the country? And I think a lot of it has to do with the speed at which thoughts are transmitted, and there's no filtering anymore. So the authenticity of the message is almost always at question, and that ties right back to active investing. So that challenges the analysts too. People in our careers look at this material, and they also have to factor in how much of it is worthy, how much of it is not worthy, what's the new news cycle. The new news cycle seems to be compressed into sometimes hours as opposed to days or weeks.
I think what we found in January, especially with the computer, the program trading that is happening obviously more now, and I keep referring back to 7 years ago. As a financial advisor, recommending positions for individual investors, I found February to be the most trying time for me because I thought to myself that the market is selling off more computer-wise. If a computer sees that interest rates have done this and a name has done that, it's a quick sell. And I think as advisors and again active investors, I feel that we have to be more on top of things today than we did 7 years ago. How do you feel about that?
Well, I think I've always puzzled about the whole earnings conundrum, earnings season. I don't mean to sound disrespectful about that process, but the whole culture of analysts listening to earnings and then immediately reacting to that by expressing themselves through the sale or purchase of that stock based on whether or not they've missed earnings or exceeded earnings. I don't know about you, but I never trade on that kind of activity unless it's extremely material, and I think it's changed my investment thesis.
I think even more often than not, it's wrong. I think the initial, the pre-market indication, you'll find that by the end of the day, but I think you're exactly right. The analysts come out with a sell, and the next day it's down 3 or 4%.
Exactly. Yes.
And it's, as you mentioned, I mean, you've held positions long term for 7 or 8 years. They're looking at 7 or 8 days, and I think you're right. That's again a concern about individual investors. Do they trade like that?
And what's truly ironic about this is, you and I are saying, well, we wouldn't do this, and I'm assuming most other portfolio managers or RIA professionals also don't do this. So the question is, who's doing it? And I do think it is what you said. It's the quant strategies or the robo strategies that have designated buys and sell triggers, and that triggers the issue. But that really doesn't help us in avoiding this short-term focus that we've been complaining.
Yeah, you brought up a great term, the robo strategy. And folks, for you out there, what that means is that a robot or a computer program will trade your positions for you. And I was told that was, Dave, this is the end of your industry. You're out.
Right,
There's no need for you anymore. You're the horse and buggy. Here comes the Ford. And I couldn't disagree with that more. I think if you used a robo strategy, you were hurt tremendously in January, February of this year. You probably didn't get back in. And I think even more important, they need people like us.
And the robo strategies, let's just talk about the client experience with them. If they are not working, then think of the meetings you have. You're sitting there and you're having to explain something that is so intangible and doesn't talk about anything to do with widgets being manufactured and that somebody has missed the widget production. Instead, a lot of advisors and portfolio managers that practice that are left to trying to struggle with explaining a highly complicated mathematical algorithm that most clients just are not interested in.
No, and my clients say all the time, Dave, just bottom line it for me.
Exactly.
What's the bottom line? Did I make money? Did I lose money?
Right.
Oh, well, you didn't. The computer did it for you.
Yes, right.
That doesn't cut it, at least with my clientele in my book of business.
And I think you're right, Dave, that there is no bottom line in quant strategies. You can't simplify it to get the point across as to what happened the way you can with, say, individual stocks.
Yeah, I think, I like another too, people don't think they need travel agents anymore, right? You go Expedia, but when you need it? When there's a hurricane and you can't get off the island.
Exactly.
I think it's the same thing with our industry. When things are going great, passive index investing makes sense. I personally think that we're needed more now than ever. Who am I to say that?
So one other point I wanted to bring up with you about earnings and the whole decorum of analysts listening to conference calls, and of course, with Reg FD, which is the Reg full disclosure of scripted, etc. So we have captains of industry reporting with scripts, and almost anybody could read those scripts, right? So the question is, what value is there in listening to an earnings call? And I think I'm probably way out there on a tail end from my peers criticizing this, but I would say that it doesn't have much value because you can read the transcript later. Maybe the Q&A session.
With the tone. I hear the tone.
The tone, yes.
Elon Musk didn't have the right tone.
Well, we were going to talk about him in a moment. That's why I was going to bring up.
I'm jumping ahead here. Sorry, I'm so excited.
Okay. And so the tone might be something. And then there's a Q&A period. And if you can imagine, these conferences are held, the conference calls are in a large conference room on the corporate side, and so you have a lot of staff there with all kinds of documents in play. And so when a question is asked, you can only imagine sometimes it might even look like the Keystone Cops, where people are running around trying to get the answer. So it's very different from the way you and I are talking right now. It used to be this way. You could sit down with a CEO, you could have a conversation about earnings, but and you might actually get something that somebody else wouldn't get. Reg FD has leveled that. So I'm not complaining about that.
Which is appropriate, I think.
Yes,
I really do that. It levels the playing field.
But one of the byproducts is the Elon Musk syndrome. Okay, so if any of your viewers had read about this, and I think probably a lot have, maybe you'd just like to highlight what had happened with Elon Musk's conference call.
I think he was upset that the question that the analyst asked was beneath him.
Yes,
right. And he said, on to better questions. And instead of going to an analyst that covers him, I think he went to a blogger or somebody that covers the firm.
So my take on that, and I'm just trying to stimulate conversation within our community, is he said several other things too. I mean, I think he actually claimed that somebody asked a, quote, bonehead question, unquote, and showed a lot of impatience with the process.
Yeah.
And just to get things a little stimulated, I have asked peers, well, what is he really saying? Is he saying that those questions are beneath him, or is it something more about the frustration with the process?
Yeah.
And I would like to think, although his style is very different from others, maybe that's what he is talking about. That
I agree.
A call like that is intended to answer or help the people calling in. What is the fair value of the stock? That's what we're all trying to determine. And when we get scripted answers and very tightly presented calls, I don't know if that's the best way of doing it. Certainly, as you say, we do need Reg FD and all that kind of compliance, but are there better ways to satisfy the ever-curious analysts out there?
Yeah, again, it's the short term versus long term. I do have one last question, and it actually, again, goes back to 7 years. You know, the VHS tape that I watched.
VHS, right.
Can you believe it?
Not Betamax.
Not Betamax. So I'm dating us. We had talked about the Fed and Fed and QE and all this.
Yes.
7 years later, we're still talking about it.
Yes, we are.
And we're also talking about interest rates, just like we were. And I have to ask you this: the 3%. We'd heard, if the 10-year goes over 3%, the sky is going to fall, the market's going to implode. Yeah. Well, that didn't happen. I mean, what do you feel? Do you even watch interest rates at this point, or how do you feel about it?
Well, of course, I think I don't want to get anybody alarmed to say that I don't watch interest rates, but I watch them with hardly any concern the way most media focuses on this stuff. A 3% 10-year interest rate, it would be fantastic in my opinion. It's still very low compared to the ranges that we've had over the past 50 years, for instance. And what puzzles me is I'm not sure there's even a Goldilocks rate, so to speak, because if rates go up, the market says, well, equities are going to go down because we have a higher rate, and that might push the investors over to bonds. But to me, the answer is if we go over 3%, that means the economy is going fantastically, and it's a great thing. Then if rates, so that's their reaction, then if rates do not go up, they're saying, well, there's no growth, so this is bad too for equities because we're stuck under 3%. So my advice is you look at the rate, you say to yourself, sooner or later it should be 3, 4, 5%. And if equities maintain their earnings momentum, I think that is the best of both worlds. And one last thing about this, I remember even back in 2008, a lot of clients were asking about inflation. Remember, the rates were so low, and they thought, and we're still talking about that now.
And whether or not it's measurable, right? Exactly. I can tell you what, I pumped gas this morning, not for a living, but I pumped my own gas because we're in Massachusetts. And I spent a lot more on gas today than I did 6 months ago. And I think what a lot of people don't remember is that when oil goes up, it typically means the economy is improving. And part of that is there's more money in your pocket too. I did fib though. I do have one last question for you.
Of course.
I'm going to read the headline that I printed off this morning. Goldman Sachs joins the cash is king bandwagon amid market uncertainty. This is Goldman Sachs telling you to overweight cash, to pay them to manage cash.
Yes, that's
correct. Can you
correct,
believe this? Are you in that camp? Are you in the cash is king camp?
Well, I've never been in the cash is king camp since you and I have met. And there are times when I had been slightly defensive. I remember when the Treasury was downgraded. Remember that?
Oh, sure.
That was the mother of all downgrades in my career. And what happened on Monday, I think it was on a Friday that was downgraded, and what happened on Monday? Treasuries actually rallied. Now, try to get your head around that. So you were thinking on Friday as you entered into
you'd be a seller.
Yes.
Yeah, you're a buyer.
And then over the weekend, what happens, I think the rationale was, well, if we are in dire straits, still the Treasury is the flight to quality and safety, so we're all still going to buy Treasuries. And that to me shows the resilience of the country in terms of how guaranteed the Treasuries are. But in terms of going into cash, I am not at all concerned the way Goldman is at this point. I think the economics of this country are amazingly strong.
Solid economy right now.
And I think there's still room to grow. And I think all the issues we have, and I know we could spend many more hours talking about this, but
we will in the next show.
Okay, we didn't talk about trade, but next time we should talk about trade because I have an interesting concept of that. I'm not at all concerned about the trade tariffs. I think that will level out, and we will all do much better all countries will do better with the trade tariffs. Believe me about that.
We're going to come back to that
on
our next show. Again, Peter Andersen, it's a pleasure to have you on Midday Money. Thanks for coming by.
Thank you.
Take care. So here's your actionable tip of the week. It's time for you to go to the flagshipwealth.com website and click on that bottom right, the broker check icon. You would be amazed how many people out there don't know the qualifications, whether or not there's complaints against the people that are responsible for running their retirement dollars. Go to Broker Check, check out who's running your money. Again, you'd be amazed the amount of people out there that will research the painter and the roofer and go to the Better Business Bureau. But just take the word of somebody that's on a podcast. No. Check brokercheck.com. Thanks for watching Midday Money.